Hey, good morning, everyone. I'm Chris Sherman, Senior Vice President and Head of Corporate and Middle Market Banking at PNC Bank. I'm also a member of the Board of Directors of the North San Antonio Chamber of Commerce and have the pleasure of serving as this year's Chairman of the CFO Forum Planning Committee. For more than 17 years, these CFO forums have informed audiences about accounting and finance best practices, relevant issues, and industry trends. We are very excited to be able to bring you 4 informative sessions this year. In a few moments, you're going to hear from a good friend of the North Chamber, Blake Hastings, with the Federal Reserve Bank of Dallas. But before I turn the program over to today's MC to introduce our speaker, I'd like to take a moment to thank our program sponsors. Our title sponsor is Documation, Prestige sponsor, JP Morgan Chase, Premier sponsors, ATKG, RSM, and VACO, Priority sponsors, BD, Deacon Recruiting, and PNC Bank. Thank you to our sponsors for your continued support of the North Chamber's CFO Forum programming. And now, to introduce us to today's speaker, please welcome Robbie Brown, Director at Documation.
Thank you, Chris, for the kind introduction. Good afternoon, everyone. Welcome to the North San Antonio Chamber's first CFO Forum of this year. We made it, even through the snowstorm a couple weeks ago. As Chris mentioned, my name is Robbie Brown, Director of Documation, and Documation has been a proud member of the North San Antonio Chamber for the last 18 years, and we're pleased to be here with you for this program today. After the year we had last year, obviously in light of COVID, we could not think of a more perfect person to kick off this year than Blake Hastings with Federal Reserve Bank of Dallas. As Senior VP, Blake Hastings oversees the San Antonio branch and is responsible for all Dallas Fed activities within Central and South Texas, including operating and administrative functions and outreach activities to banks, businesses, and community-based organizations. Blake also manages the Dallas Fed's government relation activities, which focus on federal, state, and local officials within the 11th Federal Reserve District. He is one of the 5 members of the Federal Reserve System's Government Relation Leadership Steering Committee, which guides the strategy and coordination of government relations efforts of the Federal Reserve banks. Not only that, he is very active in the San Antonio community and South Texas community, serving on several boards, including some of my favorite, Junior Achievement of South Texas, San Antonio Area Foundation, and San Antonio Economic Development Foundation's SA Works Industry Advisory Council. Blake holds a master's degree in international business, a bachelor's degree in international economics from George Washington in Washington, D.C. We ask you that you would follow along today's program, that you begin to leave your questions in the chat feature of the webinar so that Blake is able to answer them during the Q&A portion towards the end of our program. So with that, I'll hand it over to Blake Hastings and hope you guys enjoy the program. Thanks.
Thank you, Robbie, very much. And Chris, we appreciate the invitation to come back and share our thoughts with you. I think we're doing this on an annual basis, and I know it's one of the presentations that my staff and we most look forward to talking to you guys and giving you kind of an update of what's going on. So very much appreciate that. Just a quick note that I am going to share with you some views today. Some of them will be my own views. They won't necessarily reflect the view of the entire Federal Reserve System. In fact, really nobody speaks on behalf of the entire Federal Reserve System except for Chairman Powell. And even then, we have 12 independent Federal Reserve banks. So, but that being said, I'm kind of required to give that disclaimer. In the spirit of what we're doing here today, I want to just mention a couple of things about what we're really trying to do and why outreach events to the North Chamber, for example, are so important to us. We look at part of our mission at the Dallas Fed is building a stronger economy together. Certainly, we at the Dallas Fed have a responsibility as we regulate the financial institutions in our region, as we help run part of the payment system, including the currency and folding money in your pockets and purses, and making sure that's in circulation and not dilapidated, and keeping it up to date and refreshed. But also we make the monetary policy, of course, for the country as well. And as we do all of those things, we want to make sure that we're doing that in a way that is helpful to our local communities, not just at the big picture macro level for the entire country, but even in local communities. So working with the North Chamber to help you all understand what we see happening in the economy and providing you hopefully useful information that helps you with your decision making is a big part of the mission and part of our goals and objectives at the Dallas Fed. So on the next chart, you'll see, just to give you a quick orientation, I show this chart every year just to remind you who the Federal Reserve is. We are the nation's central bank. We've been around since 1913. We are a decentralized central bank in that we have 12 independent Federal Reserve banks. Each of them run as sort of their own independent businesses, but with accountability to, of course, the Board of Governors in Washington, D.C. So we have checks and balances on our budgets and the activities that we're doing. But the idea of this decentralized approach is to really make sure that the entire country's perspective is factored into making monetary policy, regulating the financial institutions that we do, and of course, running the payment system that we're a big part of. You can see where the 12 reserve banks are located. This map was drawn in 1913. As you'll notice, it's got a northeastern centric bias to it. There's a simple reason. This is where people lived in 1913. Obviously, since then, we've moved westerly and southerly. But since it was an act of Congress that drew this map, it would similarly take an act of Congress to redraw this map. And I wish you all the best luck in the world with that, given how Congress works these days. But suffice it to say, this is all part of helping bring Main Street to the process of making monetary policy. In fact, on the next chart, you'll see not only how we're divided up in the 11th district that my colleague Alfred Brewer, who's helping me with this presentation, and I work for. We're based in the San Antonio branch, which of course is the light blue part of this map. You see the territory we're responsible for. Our colleagues in Houston have sort of Southeast Texas. Our El Paso colleagues cover Southern New Mexico and West Texas. And of course, the home office in Dallas covers Northern Louisiana and of course, the northern half of the state of Texas. But to give you an idea of when we say Main Street, the next chart will show you some of the types of people that we're interacting with. The Federal Reserve is truly a public-private partnership. We cannot do what we do without having great connectivity to the private sector. So whether it be talking to banks on a regular basis, which is a big part of my job, and understanding not only what's happening in the economy, but what's happening with banking conditions and how our regulations are affecting their abilities to do business. We also talk to people involved in the payment space. And of course, we talk to business and civic leaders on a regular basis, whether it be through advisory councils, roundtables that we host all throughout our territory, focusing on different industries from energy to hospitality to the construction sector. We also have our boards of directors, and you see the San Antonio branch board here. I'll give you an idea of some of the folks from around Central and South Texas that we're working with today. Every 8 weeks, we meet with this board, along with our advisory councils and other roundtables that we do to collect the anecdotal information from these folks about what they see happening in the economy and what they see happening, what they see over the next couple of hills, what they see coming at us that's not yet in the data. When we make monetary policy, it's a bit of art and science. The science part of it are the PhD economists, the fantastic economists that we work with who do a fantastic job of analyzing the data, understanding what the data is telling us, and helping us really have a good sense of where the economy is and where it might be going. But there's limitations to that data. It's always backward looking. We don't have data for tomorrow. And so when we think about making monetary policy, we also need to listen to business and civic leaders like those you see pictured here, as well as those we talk to in our roundtables and our surveys and the other forms that we collect information through, because these folks are looking out over the next couple of months, even the next year or so, and they can see turning points oftentimes in the economy before it shows up in the data. We make monetary policy for tomorrow, not for yesterday. And so when we're making monetary policy, it's very important to blend the art of collecting anecdotes from folks like this with the science of our economic research team to really give us a full picture of where the economy is and where it's likely headed and what that means for monetary policy going forward. So on the next chart, I'll begin to kind of pivot into the bulk of my presentation. The first thing that I want to say is, the last time we met with you a year ago, we were sort of right in the middle of the beginning of the pandemic. And one thing I want to really emphasize As you saw on that map that I showed you several charts ago, we at the Federal Reserve, while we are often responsible for looking at the economy from a big picture level, setting monetary policy, setting supervisory and regulatory policies for how banks and financial institutions operate. And much of the presentation that I'll show you today is kind of looking at things at a big picture level. I want to make sure you understand that we understand that COVID-19 has really had a human impact, and that we understand that. We understand not only the health impact it's having on people's lives and the unfortunate loss of life that we have seen, but also just the impact to our daily lives, to the financial health of many households and many of our citizens, the struggle and strains that have been experienced through this last year or so. We understand that. We understand the human toll. In fact, it's really it gives us extra motivation in doing our job as the central bank to make sure we're doing everything we can to lessen the economic impact and the financial impact caused by COVID-19. And I can tell you that in the 15 years almost that I've been with the Federal Reserve now, I've never seen a more dedicated group of folks, particularly in a time of crisis, than those that work at the Federal Reserve in responding to the crisis and doing everything in our powers to try to offset that, to mitigate that, and to try to make things as best as possible and keep the economy moving as best we can through these tough times. So I'll talk to you at a high level, at a macro level, but we understand the micro level. We understand the human impact. So obviously, early on during the COVID-19 crisis, we recognized that we were what started off as a supply side shock when factories in China were shut down by the virus, and we weren't able to source our products from places like China as we normally would, quickly turned into a demand side shock when the virus hit our shores. And that quickly turned into a financial shock or a liquidity shock to the system. And so as a good central bank does, we responded immediately to the urgent need for liquidity and for stimulating the economy through the financial channels, particularly through the credit market channels, which is really what a central bank is supposed to do in a time of crisis like this. So if you'll go to the next chart, I'll give you a sense of what some of that looked like. Obviously, we lowered the Fed funds rate back down to a zero range. That's basically as low as it can go without going negative. We don't think negative interest rate policy is a good thing for the economy. So we basically have taken this tool and opened it up as wide as it can go. We've also begun purchasing assets. We purchased treasuries and mortgage-backed securities to help lower the cost of borrowing, not just in the short term, but also for longer term things like mortgages and student loans and auto loans as well. And so we've really sort of operated up and down the yield curve, both with shorter term interest rates as well as longer term interest rates to try to stimulate the economy as best we could. In addition to that, we've done a lot of emergency liquidity programs in order to restore market functioning of credit to small and medium and large size firms. You can see that some of the programs that we launched, several of these no longer are up and running. They kind of were put in place. Some of them weren't needed as much as we thought they would be, which is good news. So we've ceased to operate these programs. For example, the Main Street Lending Facility is one that was targeting medium-sized firms. We didn't have a lot of demand for that program. So unlike most government agencies, when a program that we stand up during a time of crisis is no longer needed, we withdraw, we pull it back and no longer operate that. We've also done things to provide credit to households and communities, not just businesses. So we've done things like our term asset-backed securities loan facility, which is a mouthful, but basically what that is doing is making sure the securitization process for credit card loans, student loans, auto loans, mortgage-backed securities, things like that are operating normal so that credit can flow to households and to businesses through these normal credit channels. And we've also been lending to municipal and state governments. Not a lot. Unfortunately, most state and municipal governments were able to continue to access the normal credit markets that they use, but we did have an emergency facility set up to make sure municipal and state governments continue to have access to liquidity and could operate during this time of crisis and not have to lay off their workers, which would, of course, just exacerbated the unemployment picture, as well as the services, many of the essential services that our communities need. So that's just to give you an idea of some of the things that we've done, some of the things that are still going on. A few of those are continue on through the end of this month. I would submit to you the Paycheck Protection Liquidity Program, which is meant to augment the Paycheck Protection Program that is operated by the Treasury and Small Business Administration. We provide liquidity to banks for those loans that they make in the PPP program. This will probably continue past March 31st because it looks like Congress is going to do additional funding for PPP. And of course, we'll continue to have our facility open as long as the PPP program is still making loans to make sure banks have as much liquidity to make those loans as possible. But as you can see, some of these other programs did get wrapped up and are no longer in use. So the good news is none of our programs ever got fully subscribed, meaning that the limits that we had set to us by Congress through the CARES Act for all of these different programs in terms of how much we could lend out, we never hit our limits, which means that the credit markets were able to kind of bounce back and begin functioning somewhat normally, if not a little bit impeded during the last number of months. And so we never had to max out the credit card, so to speak, that Congress gave us to keep these different credit markets going out. And I think that's a good sign. It means the economy was able to gain some traction and start operating normally for those programs. So as we look ahead and we think about where we're going, the Dallas Fed and other Federal Reserve banks, we've begun sort of reimagining how we look at information and we look at data, particularly in real time. Because as we learned during COVID-19, the typical data sources that we rely on, as I said before, are backward looking. They're often lagged, meaning they come out a month or even a quarter after the actual data occurs. And they're often subject to revisions as that data gets scrubbed and rescrubbed. And so sometimes that data is a little difficult to rely on for making decisions in a crisis because you need to know what's happening now, not what happened a month ago. And you need to make policy decisions in the immediate sense, and you just don't have the luxury of waiting on that data. So one of the things we created is a mobility and an engagement index that actually takes cell phone data, not at the individual level, but at a macro level, and tracks how people are moving around. Are they staying home, or are they moving out and about and engaging in the economy? Are they going to work? Are they going to stores? That kind of thing. And what we found is that this index became a very reliable early indicator of economic activity. The more people were being mobile, the greater the economy was performing. And of course, the opposite was true. The more people stayed home, the lesser the economic activity going on in the economy. So this new index really proved to be useful to us. We've also created some weekly indices and of course, using our business outlook surveys and doing those on a little bit more frequent basis has really helped us keep a close tab on what's happening in the economy in sort of a real time. What are we looking for? Well, if I had given you this presentation about 10 months ago, I would have told you our biggest concern was the ability of small business to survive the pandemic. As you all probably know, 80+% of US employment is in small business, not large business. And with that, we knew we weren't going to be able to recover the jobs that were lost if we lost a lot of small businesses. So the way we would look at that is that would be structural damage to the economy that would take much longer to heal from, to repair and recover from if we lost a huge chunk of small business in the United States. We continue to watch that. We continue to worry about the survivability of small businesses. We have lost a number of small businesses in our country and here in San Antonio because of COVID-19, because of this crisis. But I will tell you that the numbers aren't nearly as great as we feared. Because it's a lot easier to recover jobs with businesses that stayed in business and can rebound than having to create whole new businesses from scratch. And so as we look at the speed of the recovery, particularly from a jobs perspective, our ability to keep those small businesses up and running at some level has really been critical. So in addition to all the programs that the Fed has done that I listed before, the PPP program that I think most of you are familiar with by now, as well as a lot of efforts by state and local governments and nonprofits have really stepped in and made a difference in keeping our small business community afloat. And what does that mean? It means that the availability of jobs is directly tied to that. If 80 to 85% of your jobs are from small businesses, obviously the more of them that stay open means there's going to be more opportunities for those jobs to come back and for people to recover. We don't kid ourselves. We know not all those jobs will come back. A lot of businesses have learned to do more with less. They've shifted their business models. They've done things online. And so we understand that there has been a fundamental restructuring of the economy that's gone on because of COVID-19. A lot of the technology that we're using probably would have disrupted these jobs anyway over the next 4 or 5 years. But instead of it taking 4 or 5 years to see that disruption and those jobs being sort of shifted due to technology, it all happened, of course, in about a year's time or less than a year's time. So some of those will be permanent, and we're going to really have to think as we go forward from a local policy perspective, but even from a state and national policy perspective. What do we do to retrain these folks? What do we do to reskill them and get them prepared for the jobs that are coming back, and make sure they have the skills to match those jobs? That's going to be our biggest challenge going forward, is the skills mismatch of the jobs that are available versus the skills of the people who remain unemployed. And obviously, we're looking for signs of consumer confidence. 70% of the economy is consumer spending, so consumer confidence obviously matters a whole lot. And we're starting to see really positive signs on that. So let me go into some of the data and talk to you about kind of where we're at. So again, looking at our weekly economic index, you can see the huge drop in April of 2020 when we went into a shutdown as a nation. You can see the very nice recovery that continued through most of last year. You do see that it dipped a little bit here in the first month or so, for first couple of months of 2021. That's simply because we had a huge resurgence in coronavirus across the country, the so-called third wave that many of you have seen. And this chart really tracks not only government policy of shutting things down or opening up, but it really tracks the virus. So goes the pandemic, so goes the economic activity. The more virus that's out there, the more cases, the more people being hospitalized, and unfortunately, the more people dying, the less people want to get out and about and engage in the economy. And so you do see some softening there. That softening, though, is starting to turn, and we do expect things to be much stronger in the month of March, moving forward for the rest of the year. That's sort of the outlook that we're seeing. Looking at the next chart, you can see our mobility and engagement index that I talked about before. Again, you can see the huge drop-off that we saw in April, a sort of nice checkmark shape recovery to that all the way to the summer months. But then that's when the second wave hit of coronavirus. And the second wave, particularly, that, if you'll recall, hit the Sunbelt states, Florida, Texas, California being some of the worst hit states by the second wave. That really muted this mobility and engagement index and actually slowed the economic recovery pretty considerably. And you can see this index has remained pretty flat since the summer of last year, again, dipping a little bit at the beginning of this year because of the resurgence of COVID-19. So we continue to watch this because this really has been a very accurate indicator in real time of where the economy is today. As we go forward, you're starting to see signs of life, though. Some other high frequency indicators we're looking at, credit cards, consumer spending, you can see it's actually up over where it was a year ago. There's a couple of reasons for that. Number one, a lot of the fiscal stimulus that was done last year in the spring through the first CARES Act, and then, of course, the second round that was seen in late December of additional money that went out to folks, the extended unemployment benefits and enhanced unemployment benefits that occurred during this period of time actually kept consumer spending relatively propped up. Now, within consumer spending, some segments got hit hard, like hospitality, like restaurants and hotels and airlines were hit pretty hard, but other sectors actually fared quite well, like dine-in services, things of that nature, obviously online retailers like Amazon saw a huge boom during this period of time. But overall, consumer spending has held up pretty well and continues to strengthen. Dining in hotels is starting to show signs of life. We're starting to see things pick up ever so gradually. Our outlook for that sector in particular, for the hotel industry, is that we expect the leisure traveler to come back much quicker. In fact, there will probably be a huge, strong recovery once people feel confident in getting out and about again. People have been cooped up for a year. What will likely not rebound as quickly, though, is business travel. Most businesses we talk to are saying that because of COVID-19, they've learned how to talk to their customers and do business within their different offices virtually, and they're probably going to continue a lot of that, which means they're not going to be having people travel around nearly as much. So we'll have to keep an eye on this sector, but needless to say, the signs right now are certainly improving for that. And if you look over at TSA screenings at airports, right to the right of that, you can see there's been a gradual improvement of that as well, which we continue to say. Home-based hours worked, just sort of another indicator of kind of how things are working from a job market perspective. Again, it's pretty flat, but certainly here recently in the last few weeks, you can see there's been some market improvement from some of the February and January lows that we saw because of the resurgence of COVID. So all of our high frequency indicators are showing that weakness early in the year, but are starting to show signs of improvement as we start to turn the page, thanks to vaccinations, building up some herd immunity, with those people who did catch COVID over the last 12 months, combined with the vaccinations. We're starting to see more and more Americans are building up that immunity, and that's starting to bode well for the economy. Next chart, we'll take a look at the unemployment rate. You can see the one-time bump that happened when we shut the country down. To give you this from a historical perspective, we have never seen a jump like this in the unemployment rate. Even if you go back to the Great Depression, it didn't move up this fast, that in that shorter period of time, that steeply. But we can see the recovery is continuing to bring back jobs online. And even though we're still at an elevated level from where we were a year or so ago, we do expect at the Dallas Fed that we are going to get the unemployment rate pretty close to where we were pre-COVID, hopefully by the end of this year. That's kind of what we're looking at right now today. So moving in the right direction, to be sure. So just again, looking at our forecast at the Dallas Fed, we expect a pretty strong 2021. 5% GDP growth is really strong. Admittedly, that's not enough to necessarily fully recover the drop in GDP that we saw last year, but it's going to make a huge dent in that drop off. We do expect inflation to pick up a little bit, but it's not going to hit our 2% target until probably later this year, which gives us room to continue to operate monetary policy in a very stimulative stance to make sure this recovery holds and continues to be as strong as possible without too much worry at the moment for inflation. Obviously, we'll keep an eye on that. A lot of stimulus there, not only the monetary, but this another round of fiscal stimulus is coming in. And so we'll just have to kind of watch. And while we do expect the unemployment rate to creep back down towards the 4.5%, I will tell you that both our GDP forecasts, as well as our unemployment forecasts, we are looking seriously at revising them in a positive direction. So we could be revising our GDP forecast up closer to 6% based on new information and new data that's coming in. And we could actually see the unemployment rate get below 4% by year's end, depending on kind of how things track. These are our forecasts today, but if there's a bias in our forecasting, it's biased towards things improving more quickly than what we're putting out here in our official forecast. So we're still staying conservative in our forecast, but if there's a risk, the risk is to the upside right now, and I think that's a good thing. And of course, I don't think I have to tell you all that all of this is going to be dependent on how we handle the public health crisis. That's pretty much been true since the beginning and will certainly be true this year. If we are successful, as President Biden said the other day, and basically having enough vaccinations available to vaccinate all adults in the United States by the end of May, then that would probably cause us to revise our forecast upward. But broad vaccinations are going to be key to this. Obviously, as we see these variants coming out, different, these mutations of the COVID virus, we'll have to keep an eye on that and see if that creates any weakness, if you will, in terms of our vaccinations and other things, and creates another resurgence of the virus. So these variants are something to be kept an eye on. I'm not a pandemic expert or an immunologist, but we will continue to watch that information, and obviously that could affect the outlook for the economy as well. But we're seeing increased mobility and engagement. We expect that to really strengthen and improve in the coming months, and we're already starting to see signs of that. And of course, the critical elements are going to be continued vaccinations and testing. We're going to have to continue to keep this support, this relief, the fiscal policy side in particular for people who are out of work, and really begin looking at how to get people back in the workforce. In particular, getting women back into the workforce. And this has been one of the things that we have noticed in our analysis of the recession caused by COVID-19 that's very unusual. In past recessions, almost, well, not almost, in every case, the last 5 recessions, men's jobs were more impacted by the downturn than women's jobs. And that has a lot to do with what sectors men and women typically are participating in, things that I think will be pretty obvious to you. But this time around, we saw the exact opposite happen. We actually saw women disproportionately affected by the recession. And a lot of that had to not only do with the sectors that were impacted, like hospitality, but it also has to do with just sort of how households work. Women traditionally are the primary caregiver for both children and elderly parents. A lack of childcare and lack of schools being open placed a lot of strains on females and really in many cases restricted their ability to get back into the workforce even when their jobs may have come back open. One of the things that we're beginning to really pay attention to, and we're asking local leaders to focus on, is childcare. Obviously, getting the schools back open is going to be paramount. That's sort of mission and job number one. But we also have to make sure that a lot of the other childcare resources that we have and services that we have, as well as elderly care, come back online as well. And again, this comes back to the small business story. A lot of childcare and adult, elderly care are smaller businesses. Many of them have been really hit hard by COVID-19 for obvious reason. They had to shut their doors. We've got to get those services back online as quickly as possible in order to get our women back into the workforce. If we can't get the child and elderly care services back online, that is going to impede women's ability to get back into the workforce, and that will mean a slower recovery for all of us. So this is quickly becoming, I think, a hot issue for us, in addition to skills training, making sure people's jobs aren't coming back, get reskilled for other jobs. We need to make sure we figure out childcare and make sure we figure it out pretty quickly so we can get women back into the workforce as well. So going to the next chart, looking at Texas more specifically, you can see unemployment remains very high across all the metro areas, even in Austin at 5.7%. Prior to COVID-19, Austin was right around 2% unemployment, which is really, really low. But you can see everybody's at an elevated level. Certainly our energy sector communities like Corpus Christi and Houston have been disproportionately impacted as we saw energy prices really get hit. So in addition to the overall impact of COVID-19 hitting our state, we also, since our state is a top energy producing state, we saw the energy sector kind of give us also a double whack on the chin, if you will. And we see that particularly in the numbers in Houston and Corpus Christi. But that is improving. Energy prices are picking back up. We saw oil around $60. That's a healthy place for oil. That's actually profitable for most drillers in the Eagle Ford and the Permian Basin. And so we are starting to see energy activity pick up ever so slightly. And so that headwind to the Texas economy is starting to reverse and now become a little bit more of a tailwind. And so we should see that continue. Looking at it from a sectoral basis, you can see the red is the US and the blue is Texas. You can see the percentage of job loss that we saw across the various employment sectors. In many cases, most cases, Texas fared better than the United States. This is a surprise. We really expected Texas going into the pandemic. We were worried Texas would be harder hit because Texas has a lower percentage of jobs that can work from home than the rest of the country. And because of that, we thought Texas was going to see a disproportionate job loss to the rest of the US. Surprisingly, pleasantly surprisingly, we actually saw Texas, job growth or job loss be a lot less than the rest of the country. You see that on the far left with the total number there. Certain sectors were harder hit, like oil and gas, which is to be expected a little bit there. Also, construction was pretty hard hit in Texas. and manufacturing. But by and large, we fared better across the other major areas. And again, if you look at just the percentages down at the bottom, you can see what percentage of Texas jobs is made up by each of these categories. So even though oil and gas took it on the chin, losing about 28% of all jobs, that only makes up 1.3% of Texas jobs. And so the impact to the overall state was a little bit more muted. So if you had to pick industries, 3 or 4 industries for Texas to get hit worse in, they would be the industries you have less concentration of, and that's exactly what happened for us. So we really weathered this much better. The one that surprises me was leisure and hospitality. I really thought we would have at least equal to, if not higher exposure to job loss there. But because Texas remained relatively open during this period of time, our leisure and hospitality sector did not get damaged nearly as badly as we saw in the rest of the country. So just kind of giving you a sectoral analysis there, you can kind of see where it hit. Kind of looking at our jobs forecast for Texas, we at the Dallas Fed, we forecast the Texas economy in terms of job growth. There is data for state GDP, but it's notoriously unreliable and really kind of not very useful. We prefer to look at jobs because that's ultimately what matters. And as we consider the dual mandate of the Fed of price stability and maximum sustainable employment, it's more instructive for us to look at job growth. We are looking at a very strong job growth this year. Our official forecast right now is 4.2% job growth. That is very robust by historic standards. Our 30-year average is 2% job growth. So this 4.2% will be enough to make up a lot of the job loss that we saw last year and get us pretty close to an unemployment rate by the end of this year that's close to where it was prior to COVID-19. Not all the way there, but pretty close to it by year's end. If there is a bias to this forecast, it's again to the upward. In fact, we are strongly considering revising this forecast up strongly. I'm not comfortable giving you the number today, but let's just say that it would cause us to say that we would more than make up the jobs lost last year to COVID-19 if this revised forecast does become our official forecast. So if anything, this 4.2% is probably a low number based on what we're seeing. And that's, 4.2 is a strong number by historic standards. So the bottom line is we're thinking this is going to be a pretty darn good year, particularly in the second, third, and fourth quarters as we get the vaccinations out there, as people feel more comfortable getting back out and engaging in the economy. And so right now, both at the national level and at the state level, we're forecasting a pretty strong 2021 for Texas and the U.S. economy. So moving on to just again to give you a sense of COVID-19. Again, you can see how the cases resurged here at the beginning of the year, and we're past their previous summer peaks. They've come back down quite a bit in recent weeks, but kind of plateauing here. So we're still at an elevated level, and it's something to keep an eye on, because if there is a risk to the forecast that I've showed you, it would be any kind of an unforeseen resurgence in COVID-19. The mobility and engagement index, both for Texas and the U.S., you can see it dropped off very noticeably in February, again with this sort of new wave. And then, of course, for Texas, we saw that drop off because of the snowstorm, as well as the resurgence of COVID-19. We have every reason to believe these numbers are going to reverse and go back the other way. Obviously, the storm effects have passed, and we're starting to see the COVID-19 again get somewhat put in check as vaccinations continue to rise, and states like Texas begin to continue to open more and more. So we expect the mobility index will improve pretty sharply coming up here shortly. And then just sort of overall for the Texas economy, again, we outperformed last year the rest of the nation. Outperformed is probably the bad word. We did less worse than the rest of the nation. And that was not only because of COVID, but because of the energy sector downturn. And even though we only have 1.3% of all jobs in Texas directly tied to energy production, there are ripple effects throughout the rest of the Texas economy that oil and gas energy still matters very much to the Texas economy. So we have to continue to watch how that sector recovers. The The other thing that offset, to our surprise, some of the downturn was there still was a lot of movement to Texas by both people and firms, moving out of places like California, for example, that are high tax and high density states. And so you've seen a lot of high profile, relocations, such as, in Austin, you've seen Tesla move in, and some other companies continue to move in and create new jobs. And so despite COVID-19, that business attraction that Texas has enjoyed for the last 20 plus years continues to be pretty strong. And again, that helped offset the downturn from the pandemic. There will be structural damage, as I said before, particularly in the job markets. A lot of the jobs that were lost because of COVID-19 will not come back. And a lot of that is because of the technology that has enabled us to do business differently and realize that we don't necessarily need to refill all of those jobs because we've now got new technologies to help us do that. That technology-enabled disruption that we talk a lot about at the Dallas Fed, has for the last number of years been a little bit of an important issue in understanding why productivity gains in the United States haven't been as strong as we would like, and why the job market, is kind of seeing some structural changes. All of that structural change really got accelerated by COVID-19. In fact, our economists really believe 6 or 7 years of what would have taken 6 or 7 years to realize in terms of job losses due to technology really happened in the course of 6 or 7 months. And that really created some struggles. So there's going to be a real premium on job retraining, job skills, and making sure at a state and local level that we're doing everything we can to help those who lost their jobs and those jobs won't come back. Make sure they get reskilled so they can come into the job market where there are jobs, particularly in some of these new sectors that are being created by these technologies. This will be the issue of the next few years and likely for the next decade, particularly as we come out of COVID-19. But I think just more generally, technology-enabled disruption is here. It's not going to slow down, and this is going to continue to be a top level issue. It's really good to see that San Antonians voted for a sales tax to create a fund to help with retraining post-COVID. That was, I think, really insightful and intelligent of San Antonians to support an effort like that. But obviously, we're going to have to do that and a lot more. So overall, our forecasted growth for Texas is to be, somewhere between 3.1 to 5.3%. So take the midpoint of that, that's 4.2%. That's our forecast today in terms of Texas job growth, which, would get us to a level of jobs in Texas about 1% lower than what we had prior to COVID. So not quite making back all of it, but getting pretty close. However, if we revise this forecast upward, which I think we're going to, we could see that 0.8% below pretty much go to zero or even a positive number before the end of the year. So overall, our outlook is pretty positive and getting more positive by the day. And obviously, we'll be putting out this information on our websites so you can track it on a monthly basis with us as we continue to revise that. So I think that concludes the presentation. Yeah, I've already talked about those issues. So, the only other thing I'd say is, the Dallas Fed, we're doing a lot of programs now online as opposed to in our offices. And so we have a program series called Global Perspectives. We've had a lot of great speakers, including former Speaker of the House here for the state of Texas, Joe Strauss, who spoke a couple of months ago. We've had CEOs from around the state. We've had academic leaders speak. And our next Dallas Fed Perspectives is Cynthia Marshall. For those of you who don't know, Cynthia Marshall is the CEO of the Dallas Mavericks. She's an African-American woman, and she has been very dedicated to diversity and inclusion throughout the community, as well as the NBA and the business that she runs. So we expect a lot of interesting comments from her. We're focusing a lot more at the Dallas Fed on economic inclusion. One of the things that we've seen through COVID-19 is economic disparities have been widened between the haves and have-nots, and that's disproportionately been affecting minority communities. And one of our economic sort of premises that we're operating with right now is the economy can't operate at all cylinders if it's not working for everyone. And so we really need to think about equity more and more in the economy, making sure that we have everybody participating in the economy, and that's good for everyone. A rising tide lifts all boats, and we're going to continue to do more research on this topic. We've had a lot of conferences around the Federal Reserve System on this topic to really think about the importance of thinking of economic equity and inclusion as really being an economic imperative. Because as we leave people behind, particularly minority groups, that's not good for the overall economy, because that means the economy is not operating on all cylinders. And I think the conversation with Cynthia Marshall will continue to help us understand some of those dynamics from her perspective as CEO of Mavericks. I know we're all Spurs fans on this call, but I promise you Cynthia is a fantastic speaker, and I think will be a fantastic conversation between her and our president, Rob Kaplan. So going back to the previous slide, again, if you want to follow us and get more information on the Dallas Fed, please feel free to look on our website, and you can track all of the data and statistics that I just shared with you. We keep them up to date on a regular basis on our dallasfed.org website. So let me stop there and see what questions you might have.
Thanks, Blake. That's great stuff. And just as a reminder to the audience, if you just want to put your questions in the chat and we'll read them off. And kind of while folks are doing that, Blake, I'll kind of kick it off with a question. You had mentioned a couple of times that forecasts could be revised upward later this year. What are some of the data points that you're seeing at the Fed that are kind of driving some of that optimism?
Yeah, so it's a couple of things. It's not just data, it's also the anecdotes. Remember, I told you that we look at both the data and the anecdotes from business leaders. We do a lot of surveys of businesses where we kind of collect the anecdotal information and actually turn it into a statistic through our Beige Book surveys, our energy outlook sector survey, our retail sector survey, our manufacturing survey. All of those surveys are indicating pretty robust optimism. Consumer sentiment and business sentiment matter a lot in driving the economy, because the more confident businesses and consumers feel, the more they're willing to go out and spend, whether it be to consume or to build their business and invest in new plants and infrastructure or new employees. And so everything we're seeing indicates a pretty strong recovery. We're also beginning to see early signs on the mobility and engagement indexes as well, that consumers are getting back out there. The more people that get vaccinated are getting out there feeling more confident. I'll tell you personally, on my own personal side of things, I've been vaccinated. I've gotten both shots, and pretty much after 7 or 8 days after the second shot, I started going out to restaurants more. I started feeling more good about participating in the economy, and not feeling it was as risky for me or for my family since we got vaccinated. So anyway, I think those are the reasons. Those are the anecdotes, Chris. I don't think there's one specific number that we're looking at, but it's pretty optimistic. In fact, if anything, we're beginning to kind of think, at what point do we need to start removing some monetary accommodation, right? Because if it does turn out to be as strong as we think it's going to be, or could be at least, then we may have to start thinking about normalizing monetary policy more sooner than perhaps we'd originally thought. Now, I'm not trying to make a news story right there. Nobody's changing monetary policy today, but we're beginning to ask those questions, as we should. As the economy goes, monetary policy should go with it. And so anyway, it's a whole series of data and anecdotes that are really driving this viewpoint. I think the biggest number, though, Chris, will be the number of vaccinations. As we continue to see the percentage of Americans who are vaccinated rise, percentage of Texans who are vaccinated rise, you can almost draw a direct correlation to economic activity. That's our thinking, that the more Texans and Americans get vaccinated, the more the economy is going to start hitting on all cylinders again.
Well, thanks. That's great insight. And I guess kind of along those lines, we're starting to see the 10-year treasuries increase. You talk about some of that optimism in the economy. What are the key things that the Fed, just broadly within its mandate, monitors when it thinks about adjusting its asset purchase program or other monetary policy to making sure kind of the timing aligns well, that you don't do it too quickly to slow down the economy, but you do it fast enough to kind of not let inflation run away?
Yeah, and so we made a very important adjustment to our monetary policy framework last year. We had hit, prior to that, set 2% as sort of the target inflation rate. for the U.S. economy. And we've not changed that target. But before, we sort of used that as almost as a ceiling, that once we got to 2% or got real close to 2%, we needed to start dialing down the monetary policy stimulus to cool, to make sure we don't overheat past 2%. We've now changed our philosophy where we're saying we need to average 2% over the long term, which means if you're below 2% for a long period of time, let's go ahead and run above 2% for some period of time, so that the average is 2% over the long haul. And the reason for that is to make sure we really get the unemployment rate as low as it can possibly go. And when we think of things, Chris, like equity and inclusion in the economy, one of the things we realized prior to COVID-19, when the unemployment rate was really at historic lows, like 3.6% on a national level, we realized that we started to see many people, particularly minority groups, people who are often left out of the economy, coming into the workforce. And so there's a broad recognition that keeping the unemployment rate a little bit lower, as long as inflation doesn't get out of control, enables us to bring more people to participate in the economy. And that's a good thing for the overall economy. And it's certainly a good thing from a social perspective that, we get all people included in the economy, not leave some people out of it, or left behind. Other things are going to influence that too, like digital access, skills training, all those other things that are more part of fiscal policy. But so we've really changed through the new policy framework, this idea that we can run above 2% for a period of time, so that the long-term average is that 2%, as opposed to using it as a ceiling, as a hard ceiling. So with that mindset, I think the monetary policy position today is we're going to let this thing continue to go, even if inflation picks up a little above 2%, because we really want to drive unemployment as far down as we can go to really reach true full employment, not just employment that gets you to 2% inflation. That's really, I think, the idea here. And that's an important policy shift. It may seem like a nuance to you all listening, but it's a really important policy shift, because I think it's a recognition that we need to do more to lower the unemployment rate to get everybody in the economy. And if we use 4.5% or 5% as the target for unemployment, and 2% for inflation, then we may still be leaving a lot of Americans out of the economy. And I think there's a recognition we can't do that anymore. So on the long haul, we're going to want to average 2%. If there is a period of time where it's above that, we're going to eventually want to take policy steps to bring it back down to the 2% level, not let it run too hot for too long. Because inflation, of course, is a tax, particularly on the poor and the elderly. But I think that's kind of the view right now of our policymakers is that's how we're going to treat monetary policy, which is why the large expectations of the financial markets is to continue to see accommodative monetary policy for a while. Now, that being said, I should note that you've seen some tightening in monetary conditions, not because of Fed actions, but just the markets themselves are really starting to feel confident in a recovery. And because of that, you've seen Treasury rates begin to pick up. So the 10-year Treasury is now right around 1.5%, which 6 months ago would have seemed like an impossibility. We couldn't keep it above 1%. So the fact that the Treasury rate is up to 1.5%, it is going to have a knock-on effect on things like mortgage rates, right? It's going to lift mortgage rates, and that could cool the economy. So we're watching that at the Fed. Because we don't think the economy's quite yet ready to cool off. But on the flip side, it's a positive sign that financial markets are baking in a strong recovery. And that's why you're seeing upward pressure on interest rates. So it's not all bad news, but we're going to watch that because we're not quite ready for interest rates to go spiking up just yet. We want to make sure this recovery takes hold. We want to make sure the virus gets under control. And that related to that, the economy is able to continue a path forward. So we're going to keep the pedal down on monetary policy until we feel like we're really past we're really out of the woods.
That's great insight. Thank you, Blake. I sincerely appreciate that. I'm not seeing any additional questions in the chat right now. So I think with that, I'd just like to say, Blake, again, thank you. Always enjoy this every year. Very interesting, data points and great insight on the economy here in San Antonio and Texas in general. Sincerely appreciate your time. And hopefully when we do this again next year about this time, we're talking about how much you had to revise that forecast upward, in the second half of the year, because the recovery just went faster than any of us could have planned, right?
That's the hope, and I wouldn't be surprised if that's the case as well.
Wonderful. Well, thank you again. And to all our participants, thank you for being here today and joining us. And please be on the lookout for information about our June forum that we are hoping to hold in a hybrid fashion to offer folks the opportunity to attend both in person and virtually. Thank you again, and this concludes today's program.